Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council, Incorporated. Welcome back to the show, Danielle.
Good afternoon.
Danielle, how many people have what you might describe as a flawed retirement plan? I remember seeing a story that said about 11 to 14% of people are saying their retirement plan is winning the lottery, and that's the same percentage of people who believe that Elvis is still alive.
Well, I'll tell you what, that is an extreme part of the grouping, but I would argue that the majority of people who have a retirement plan are still gambling on winning the lottery, even though they're not aware that that's what they're actually doing. And so I wrote a fairly lengthy piece on the blog today about fantasy planning yields financial disappointment, because in my 30 years or so of looking at people's finances, I've seen a lot, and what I see mostly today is people who are very nice people, financially disciplined. They've been saving. They've been trying to do the right thing. But they've got this expectation in their mind that you should be making, 5 or 7% a year, and that in retirement you should be able to withdraw 5% a year and not draw down your principal. And they got that from the 1990s, like back then when we all had 1990s fashion and things. That's the last time that those numbers were actually present in reality, and yet people are still factoring in those assumptions. And the worst case is that even their, the financial sector marketing materials and salespeople, planners, even some of their accountants are telling them that that's a reasonable expectation. So I'm trying to point out to people that the math is no longer the case, because, back then, in the 1980s, for example, the decade started from very high interest rates and fell into 1990, but even during the 1980s, as rates were coming down, the average on government bonds, guaranteed investment certificates, the things that people always sort of thought of as where one keeps one's savings, were yielding about 10% over that period. So when you're yielding 10%, you can withdraw 5 or 6% a year as income in retirement, and you'll still leave some, 5 or 4% of income, interest income in the account to pay fees, if you're paying financial management fees or mutual fund fees or whatever they are, and also to reinvest, because the whole engine of compound growth, as you know, Jim, is actually from income being reinvested. So when we look at the long-term returns, everyone talks about equities as this, outperforming asset class. In reality, when you look at the long term over multi-decades, the average of 6% return that people assume is normal for equities, about 4% of that came from dividends that were not taken out, that were not used for fees, but were reinvested 100% in perpetual motion. So this investment of that 4% dividend got income or interest and dividend on dividend. And that is where the bulk of that 6% growth came from that people expect or associate with the long-term trend in equities. Well, if you look at today, the reality is that even equities, if you're looking at, like things like the Canadian, financials or dividend-paying shares, we're still relatively higher than in many other places, but the actual yield is about 3% presently, 3% and less, depending on which sector you're talking about. And the thing is that most people are owning that inside a portfolio where they're paying 1% or 2 or 3 even in some of the really high fee funds to own that asset. So, if you're lucky, the income is paying the fees, never mind affording one a withdrawal in retirement. And still people have assumed that they can, not only pay their fees, but also be taking out 4 and 5% going forward. So again, that's an artifact of an era that was in the 1980s, and then even in the 1990s, interest rates continued to fall, but still they averaged about 5% in that period. So even if you were, paying a couple or 3% a year in fees, you could still have some reinvestment, some compound growth. But then when we got into the 2001 recession, of course, central banks slashed rates. Greenspan took the U.S. base rate to 1%, left it there for a year, and then by 2007, rates had crept back up again, but they were still, on the guaranteed stuff that it was always assumed to be the most appropriate holding, they were less than 4%. And so, then of course, as we know, in the Great Recession, they got hacked down to, 1%. Things recovered slightly as rates began to increase again. In 2018, we were back, getting 2.5% on the highest quality assets. Well, now we're less than 2% again. If you look at a 30-year government bond, even in Canada, it's 1.5% today. GICs are yielding 2%. So what many people have done, instead of just acknowledge that math is the reality of today and that it's still appropriate to keep the bulk of one's savings in guaranteed instruments and things that will protect your principal, right? Just like pensions have always done traditionally. And in the last decade, as rates have been low, a lot of pensions as well have migrated towards much more risky asset classes. And their idea is, well, we can't afford to be in the safe things because it's not paying enough and we can't justify our fees and we won't be able to meet the payout requirements. But the reality is that that's a recipe for a lot of pain, because what they're doing is, especially if you're an individual, you just don't have the time horizon to buy things that could lose 20 to 70% of their value, in some cases 100% of their value if a company goes bankrupt. So I'm trying to say to people, look, a government bond and an equity are not apples to apples by any stretch. They're more like an apple to a kumquat, and the kumquat is something that, you can't assume is going to make you the main meat of what you're looking for in terms of your retirement savings. So the answer is that you should be saving more. You should be deferring withdrawals as long as possible. That means for most people at least to their age 65. And that once they start withdrawing, they should try and keep the amount that they're taking out at this particular point. With rates the way they are, you would be better off to try and just take 2% a year, not this rule of thumb from the 1990s of 4 and 5%. And that way you're less likely to draw down your principal really quickly. So, people will say things to me like, well, I can't afford to make 2% because I need to have more income. And that's just another way of saying to me, I can't afford to lose my principal because I don't really have enough capital saved to support the lifestyle that I'd like to have. So, if you think about how perverse that logic goes when one says, I don't have enough capital saved, and then they leap to, therefore, I have to risk it more, I have to gamble it more. And this takes me back to this whole idea that people are actually, gambling with their life savings, in a way of hoping to win the lottery, even when the prospects of reward or of success are so small. Probabilities are so small that that's going to work out. And more likely that you're going to lose a big chunk of principal and spend years thereafter, either with a big hole where you have to go back to work to try and resave it, or, you have to downsize your life and lifestyle in the meantime while you wait for it to heal, so to speak. So it's a very bad plan in real life. I always say it's much better to, appreciate facts than to live in a fantasy and then wake up in a nightmare. And so I laid that all out so that people, because I know that they're talking to others who say, well, the rule of thumb, and it's true, the rule of thumb used to be that you could take sort of 4% a year out and not erode your principal over time. But if you look at why that was, you understand now, it was because, nominal rates were 10%, and then they were 7%. And then once you get down to them being 2, clearly we're in a different paradigm. So the answer is not how do I find more risk, how do I gamble more, it's how do I make this math work, and how do I keep my principal protected so that when things come on sale again, because this is not going to be a perpetual state of extreme valuation in many of the, dividend producing stuff, for example, which right now is insanely valued, and ripe for great loss and hardship. If you can steer clear of that and keep yourself sort of, sustainable in your cash flow plans in the interim, then you're going to have an opportunity to add some of this stuff back at higher yields once prices come down again. And then you're not gambling. Once prices come down significantly, it's much more investment grade again. Not something you're going to move, 100% of your savings into equity things by any stretch, but it will be a much more rational bet to say, hey, I'm going to move, 40 or 50% maximum into that asset class where dividend yields are now going to be 4, 5, 6, 7% because prices have come down so significantly. So that's the whole, it's the whole matrix thing with the red and the blue pill. You can take one and keep sleeping and then wake up in horror, or you can reality check, see facts as they are, and adjust your behavior accordingly. And that's the course that I recommend.
We'll have more with Danielle Park right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Danielle Park. Danielle, General Electric seems to be shuffling the deck when it comes to their pension plan. Are people counting on their company pension plans for their future? Because I look at, the people who are at Eaton's or other companies that have gone under and what happened to their pension plans and their futures. How rocky is the corporate pension plan?
Well, this is a symptom of the same problem that I was just speaking of. The reality being that, again, going back to the 1980s, the bulk of pension funds were managed in the most secure instruments. They were making a stated rate of interest per year. People could do forecasts and say, okay, we need to put in this amount per year because we're making this amount and our liabilities are that, and they would match bonds to be coming due in the year that the payments were due and all that. What's happened in the last 3 decades is rates fell. The population aged, and the expectations for, what retirement comfort should look like in terms of lifestyle. It's all been this great sort of mess of increasing expectations just as real returns were falling. And so what people did, as I said, is to take money out of safe, protected spots and put it into Wild West gamble spots. And they've done that inside institutions like pensions. In the process, the other thing that happened was there was a decision to underfund on an annual basis because there was more expectation on these bets paying off. So instead of, again, saying, okay, this is actually what we're earning, therefore we have to put in this much this year to, make sure our pension is on track, they kept deferring that and saying, let's imagine that we're going to make 7 or 8% a year. And then if we do that, that means we only have to put in X instead of Y. And what happened is they accumulated deficits, which have grown year over year. And when, originally they said, we'll reconcile this every 3 years, and if we haven't met our target over the 3-year growth rate, we'll then top up contributions. Then they changed that to let's, drag it out over 5 years. Let's see if we hit our target over a 5-year period. And then they started trying to argue for longer time windows. And all that happened was that deficits continued to grow. Contributions fell just as more people started to take out. And my big beef with all this is that, so it's the same thing. It's the fantastical assumptions about what rates of return and how that will meet liabilities or requirements for withdrawals. And of course, there's been a huge disconnect. At the same time, there's been a lot of fees taken out of these plans by the people that have been hired to be magicians, to apparently make all these ends meet with magical solutions. They come at a high price. And so they've charged a lot to hopefully win, but they haven't won to a sufficient degree. Enough of their bets have not been successful. That's the odds of that kind of thing, to make up the deficits. So it's been a very destructive chapter. Not only have they been underfunding relative to their returns and their requirements in terms of payouts, but at the same time, the companies have been borrowing tons of money, not to top up their pension plan, Jim, but to buy back their own shares, right? So this is the C-suite enriching itself at the very expense of the working class, of the working people in their company. So they put IOUs in the pension plan, and they issue bonds and buy back their own shares. Because in MBA school, they show you that leverage, when you can borrow money right off the interest and buy something that goes up in value, that's positive leverage and it can magnify profits. The problem is that it's a highly speculative pursuit, especially when the assets you're buying have a propensity to blow up every 5 or 6 years. And indeed, that's precisely what's happened with the GE shares. The more they got less focused on innovation and how to make a sustainable business model, where technology was going, where they should be going, they lost the whole focus on that and really looked at how do we make all these speculative allocations, how do we lever up the balance sheet, and so what happened was they were buying, for lack of better or more productive ideas, they were buying back shares to make profits increase rather than finding out ways to be innovative and really, take your business in all sorts of interesting ways and increase revenues. They said, no, let's just figure out how to increase profits per share by buying shares. So they did things like spent billions, buying shares, over the decade up to 2017, they spent something like $54 billion repurchasing their shares at an average price of 26, while today the shares are just about $8 each. So this is what I call a massive money evaporation machine, right? When they have literally thrown good after bad, they're now left with a lot of debt on their balance sheet, and they do things now like say to their pensions, sorry, we're going to have to freeze the pension plan because the deficit's getting bigger, and every time the deficit gets bigger, that's more capital we have to allocate and put into to top it up at some point. So this has been going on not just in GE, of course, in many of the large companies, the Halliburtons, the IBMs, a lot of them have done precisely this playbook. I swear they all learned it from the same business school, the executives that came up with this brilliance. And it's been a very, very financially destructive chapter.
We'll have more with Danielle Park right after the break.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. A lot of people wonder, why should they get a humanities degree, English, Greek history, when there's this big demand for high-tech people or for nurses, doctors, and engineers?
Mm-hmm. Well, because, and full disclosure, I'm biased because I did do a humanities undergraduate degree before I went to law school and before I went to finance. But basically, there's this dearth of creative thinking today, which can be a problem. Not in everyone, of course, but in many, many sectors, and in business in particular. I call it the tyranny of the MBA class, basically, where they did a business undergrad in many cases and then went on to do a master's of business administration. And so what they've learned from that is the same kind of thing you learn in the CFA degree, which is, how to add leverage to a positive effect, how to financialize, how to do financial tricks and gimmicks to make the balance, or to make the income statement and the financial statements look better, to get the equity price up, instead of how do we really solve problems, how do we explain things better to the public, how do we have empathy for things like workers, why do we know that we shouldn't underfund pension plans, how do we make for a better world, multi-stakeholder kind of model, which we've talked about before, with the whole Milton Friedman thing from the 70s talking about, that shareholder primacy thing, that really all you have to do as the executive is worry about getting the share price up and pleasing the shareholders, yourself being a major one of them, typically, because you're paid in shares. A lot of your compensation is paid in shares. So there's this very, as I say, destructive short-term view. Really what you need is a lot more diverse thinking. You need, an understanding of history, an understanding of sociology, psychology, philosophy. These things, English literature, and helping you to communicate well with people. All these things are extremely useful in fortifying or giving people complexity in their character and the way that they see the world. So there was a TED Talk from Eric Berridge, which I put on the blog this week, and he was just saying, they came to a great impasse in their business. They couldn't figure out how to solve a technology problem. They were about to lose a massive client, and they sent in someone who had a humanities background, and they spent a couple of days, looking at the problem from a different angle, and were able to solve it. So I appreciate, in today's world, it's very difficult for many people because education has become so expensive. And if you're looking at, coming out of high school and going into some kind of post-secondary where you have to go into debt to do it, there's a lot of anxiety around, I can't afford to just have a liberal education, and then maybe do a second degree after that. And I understand all that. But I guess from a parent's perspective, I'm just thinking, to give your kids some latitude, because I think this linear expectation that one comes out of high school, goes into some program of study, comes out of that and does that for the rest of their life is actually not borne out by the facts, because many people change careers many times, and many people in tech will talk about, or in the STEMs will talk about something, either they're voracious readers of humanity-based subjects or they have some experience. I remember Steve Jobs, for example, talked about when he was founding, some of the Mac, putting together the first Mac computers, the whole multi-scripts that they came up with were influenced by a class in calligraphy that he took in his undergrad. So, of course, learning about Greek characters and all that, which seemed completely random and off the mark back then. Why would anyone be taking that, especially if you're interested in tech? But then it came to be a major part of some of the stuff they styled for the Mac. So it's just, I think, we need to do more reading. I think that there's something very positive and productive that goes on with reading, books, not just tweets, not just snippets, but actual, sitting there with someone's very developed thoughts, digesting them, ruminating and thinking about what you think about them, and then sharing that with other people in conversation. I think that's a lot to do with how we improve the depths of our thinking, and as I say, the more balanced and productive it tends to be, rather than just one view and a linear thought about how do we make this one thing.
Danielle, thank you so much for chatting with us.
Hey, thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.